What's going on, guys? Anthony from Market Chart Watch. Today we're going to be talking about the implied move for tomorrow, which will be April 17th. We'll be looking what happened today, April 16th, and we'll talk about how that play that I noted yesterday worked exactly like we talked about. I'm going to show you how much money you would have made on that play had you have done it for downside protection, and then we're also going to talk about what tomorrow's move will likely be, or what the probability is, and how we can downside protect against that move. Okay, so let's start by looking at what happened today briefly. This is the SPY, so the S&P 500 index, and you can see today we opened and we did drop approximately 1% on the day. And then if we look from the day previous to today's close, we're down about 2%. So the implied move of 1.05% that I noted yesterday is pretty much exact. We did pretty much move implied 1.05%, give or take. So that's pretty amazing. Now, I did also note that the way that this was likely going to work is that we were going to fill in some of these gaps. So the market had called for a downturn. The put options were pricing that in, so we figured we would probably move down and we would probably hit some resistance here and then try and hit back up here. And we would either take off in this direction or take off back down into the lower direction. And so what did end up happening was the market could not hold up at these highs. And so it broke through here, and I want to show you this large candle here. So this candle shows lots of volume. I'm going to just narrow this a little bit. This candle here shows tons of volume, tons of volume. So both of these showing a lot of sellers outperforming the buyers here. And so the move that we talked about yesterday talked about this put option and how we could utilize it for downside protection. So had you have used this today on the SPY, I was showing you on SPX, so it was a bit more expensive. But if this was the SPX, that trade was going to cost you $1,700 to open in the morning with a downside limit of around $355. So your potential loss was $355. That's where you get stopped out. The trade cost you $1,700 to get in, and you would take profits of between $900 to upwards of $3,000, depending on how much of this you wanted to cover. So the setup right here was pay $1,700, max loss of $350, and the gain would have been $1,000, okay, on the trade that I had set up. But what we did today, or what the move did today, let's see what would have happened if you were just playing this intraday and you were being super conservative. So say you were playing this move and you saw that this had bottomed out, and then once this green candle started overtaking the red candle here, the buy candle, that's when you decided to sell out. So we'll just say you decided to sell out right there. Okay, this move would have netted you from here to here 7.12 basis points. So we'll just assume that the delta is not changing. Okay, so this is going to be the most conservative figure, i.e. the least amount of money you'd make. So the least amount of money you would have made on this trade is $391.60. However, since the delta of an options contract does change once you're in the money, we were buying the 530 or the 529 put, okay, which means right here, let's call it right here, from 529, that delta went from basis points of like a 50-50 chance, and it started getting into the 80s and the 90s down here. So it's variable, but as you start getting in the money, it's going to be closer to 1. So let's just say from here on down, our delta became much higher because of the probability. So what we can then say, look how crazy this is. Okay, we'll just call that move 6.5 basis points, okay? And then we're going to multiply that by a delta of probably 90 or more. So your payout was actually closer to $600 on this trade based on the implied delta move. And that is awesome for a one-day trade, getting in and then having a move that's sustained. So you started here and you ended here That is a 2-hour window, give or take, okay, for a $600 profit on a down day. So say you want to set up a trade like that tomorrow. That's what we're going to talk about in this video. So let's take a look at the options prices for tomorrow and the VIX. The VIX is sitting at 32, so still high, but not as high as it has been recently. So we're still trending downward on that VIX. That's a good sign. That's less volatility in the market. Let's look at the options contracts for tomorrow on SPY, and we're seeing that the last sold price was 525.66. So that's going to be closer to 526. Our ask for the calls is $502, and the ask for the puts is $413. So what we can see here is we have about a $75 premium on the call side to buy an option, which means the market makers have priced in a premium that the stock is going to go up tomorrow. But let's assess how much that would actually take to go up. Okay, or what our implied move would be. So again, we're going to take the call side of 502. We're going to add it to the put side ask, which is 413. We're then going to divide that or multiply it by 85 percentile to get rid of the highs and lows. And then we're going to divide that into the underlying strike price of $526, which gives us an implied move of 1.47%. So what will that mean for tomorrow's move? Market makers have said that there's an implied volatility move of 1.47%. Well, let's map that out. After hours is pretty much flat, so this is actually perfect. After hours is basically right where we ended the day. A 1.47% move, watch this. Look at that. So the market makers have said that the likely move for tomorrow is a move in this direction, right to the edge of this gap fill that we had. Okay? So that's pretty amazing. So right to the edge of this gap fill. So that's a pretty interesting move. Now, if the market makers were wrong about that and say we had an implied move to the downside of 1.4%, that would take us below our recent lows of the last week. So we have two pretty cool trades that we can set up for this that are directional and will have high probability. Do you want to see what those are? Stick around. Let's set them up. Okay, so let's say that we want to set up a trade for the put side, for downside here. We'll do a short position, and I want to set that up at or below the recent lows. Okay, so I'm going to take right here, it looks like 520. I'm going to bring this down just a fair bit more, maybe about right here, okay, give or take. So I just want to bring us below those recent lows, just a smidge. And I'm going to, sorry, not to make you all dizzy. Okay, so where am I going to take profits on this? I want to take profits right around here where our previous lows were as well. So somewhere in this region here is where I want to take profits. I'm going to be conservative, take profits there. And then my stop loss for this, I would want to be somewhere around this move here. So what am I setting up? I'm setting up a put contract. So I would buy a put, and I want to buy that put only if the stock price tomorrow reaches the recent lows and breaks through them. Once it breaks through into this green area, I purchase the contract, and as the stock price goes down, I make money until it sells at this point, which is previous lows over here, for a profit. Okay. Conversely, zoom back in. Conversely, to manage my risk, let's say this does move in this direction and then it reverses somewhere over here for some reason, which isn't likely because there's no technical indicators for support or resistance. But let's say it does. Let's say it gaps down here and then the trend reverses. I want to get out of this trade as soon as it breaks these recent lows, because this is going to be its resistance. Once it breaks out of that resistance, the only place for it to go is up, 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 and you're going to lose and lose and lose until you've lost that entire trade amount. So we have to set definable risk here. And so this trade is a 1.39 to 1 risk reward. So it's not the best, but this would be a high probability trade. Okay. So setting that up, we can look at the options market. We can buy the ask, which is $413. So this would cost $413. And given that this is around a delta of 50 at this time, our profit potential would be about $370 on this move. So we're almost making, divided by, this is an 89% return on investment if the stock moves 1.2 or 1.42%. Conversely, our risk for this trade is 5.31. So we're risking approximately $265 max on this trade. And so you have to decide if this is allowable for you to risk that amount of money. So we're buying this for $413. We're risking $265 with a minimum potential to make $367. Okay, but keeping in mind that if this does continue down in this direction, it could likely become, so this trade would be, so this is 367 here, this is about $550, $600, and then if you bring this down to the lower end of this gap, you're looking around like $2,000 to $3,000. Okay, so this is how you mitigate that downside risk. This is just a single contract. And you can imagine if you bought multiples of these, that 300 is now 3,000. This 3,000 is now 30,000, etc. So this is where options can leverage you to benefit you in down markets. Okay, so that's one trade we could do. The next trade we can do is, say the stock does improve and breaks back out of this fair value gap. Look what happens every time you break out of a fair value gap. You have insane volatility. Okay, so if we break out of this fair value gap, nothing is going to stop this except for this next gap fill. So we can actually use this to play the call side. So let's do that. Okay, so assuming we break out of this, I want to buy in right at that channel. I want to sell out. I want to sell if we break back into the channel, because I don't trust that we would come in here and break back out. And so this would then, I would sell here. So this would be about a 2.3 to 1 risk reward. And then we can actually bring this down a little bit to give us about a 2 to 1 and give us a little bit more, a little less leverage. And so with this trade, if we wanted to buy the call contract, we would be spending $500, $502. And our loss potential, let's see what that would be. So we're going to spend about $500 on this trade. Our max loss potential is going to be $125.95 if we set this stop loss where it's at now. And then our gain for this contract, if we have a limit order here for 3, is about $243. So we're spending $500, risking $125 to make $243. And again, this would be about a 47% return on investment. So you can see that this trade is less profitable, also less risky. The other trade is much more profitable, but you have a bit more potential loss. So you have to look at these as which one do you prefer, or you can actually set up both. So I can I can set up both of these trades. I've done this before many times when I'm not too sure on directionality. And I can set a trade up just like this. So I own both, and whichever way the stock goes is the way that the trade goes. And I will either purchase this call trade if the stock goes that way, or if, sorry, this should be down here like this. There we go. Or if the market continues to go down, this trade would execute, and then I would make profit that way. So a lot of times that's how I will play these trades. I will typically own both and then just delete one when I see which direction the market is played. And that's typically what we will do. So the implied move, just to clarify for tomorrow, is priced into the upside at a rate of about 1.5%, which brings us to the top of this gap fill. And so this will be something where I could open in the morning, set up either one of these trades directionally, and go from there. If you guys like this video, please comment down below, and then I can actually show you on Thinkorswim platform how to set up one of these first trigger OCO trades so that it is all just set up and ready to go. You don't have to watch the market. You can set all these triggers, and it will work much faster than you possibly can. I can guarantee that. Thanks for watching. It's been another video from Anthony at Market Chart Watch. Like, share, and subscribe, and we will see you in the next video.